So here it is. The market crash has arrived. What everybody has been talking about, it seems to be here, but maybe it's not. Maybe the market's not actually crashing. And I know it's frustrating out there listening to different commentators talking about whatever they think is maybe happening, or maybe they're just trying to sell products from their website. The reality is what you're going to get here. So let's talk about what's actually going on in the residential real estate market here in the Las Vegas Valley. I am Justin Miller with the Chong Miller Group. We help people buy and sell homes. Every month I put out the monthly market update. I put out 2 videos, one for single family residences, which is this video, and also one for condos and townhomes, the companion video to this. The single family residential video, I have a little bit more analysis behind the numbers, what may be driving the numbers. The condo and townhome videos tend to be much more focused on the specific data for those 2 market segments. So what's going on right now in the residential real estate market, and why is it happening? Well, obviously interest rates have been increasing. Interest rates have been increasing because the Federal Reserve has decided that their singular focus right now is on trying to restrain inflation, trying to drive down inflation. And I'm going to suggest their singular focus is problematically placed. And we'll talk about that in a couple seconds. But in their singular focus, they are specifically controlling and pushing up the federal funds rate, the overnight lending rate. And that signals the bond market and bond buyers and bond sellers in the market, specifically the market we're interested in, the mortgage-backed securities market, take their cues from the Fed as to whether or not interest rates should be going higher or lower. And that changes the level of demand they have for bonds. So as demand for bonds goes down, pricing goes down because there are fewer bond buyers in the market. And so there's excess supply of bonds, and that pushes prices down because there's no one there buying them, or fewer people buying fewer of them. And as prices go down, that means the interest rate being paid on those bonds or being required by those bonds goes up in a completely linear inverse relationship. A bond price going down means interest rates go up. So as the Federal Reserve changes interest rates in the federal funds market, that signals market participants in the mortgage-backed securities bond market that maybe they wish to decrease their demand, pushing prices down, pushing interest rates higher in the mortgage market space. Well, that's been going on. It's unfortunately an indirect signaling process. And so the mortgage-backed securities market sometimes gets way in front of where the Fed is pushing interest rates. Or they move more quickly. They could potentially move more slowly. But in this market, we've seen over the past 9 months, that the mortgage-backed securities market is often front-running what the Fed is doing. So mortgage interest rates have gone higher, considerably higher than actually the federal funds rate would suggest they probably should be. And mortgage interest rates therefore have come back down. But this has not been a straight line process. Rates have fluctuated, and every time the Fed increases the federal funds rate, mortgage bond holders become more concerned, and they run out of the mortgage-backed securities market, pushing those prices down, pushing mortgage interest rates higher. And so the Fed, in being very aggressive in the way in which they're increasing the federal funds rate, has been maybe scaring some of the participants in the mortgage-backed securities market, pushing rates higher. Every time the Fed moves, rates go higher, and then they tend to come back down. And so last week, we saw mortgage interest rates, 30-year mortgage interest rates, at the average, according to the Mortgage Bankers Association, going up to about 5.75%, coming back down again some this week. We also see, however, some sellers are out there, like developers perhaps, who are buying down interest rates on particular loans. And so when you take out a mortgage loan, you can actually prepay by what's referred to as by a point, a discount point, reducing the interest rate on your loan. So there's ways that you can decide the interest rate that you're willing to pay based on prepayment of a discount point if you're willing to do so. Now, interestingly, that means that the average of what's actually been financed over this past month has seen interest rates that look like 5.3%. That's higher than it had been last year, most definitely a little under 3%. We're up about 2.25% from where we were last year. We're still low in terms of where interest rates have been historically. Now, for those of you who've been getting mortgages at that 3% or below 3% level, that's been really nice, and it means your payments have been lower in your property. You cannot get that loan today. You'll probably never be able to get that loan again, just because those rates literally had never been seen before in the mortgage market space. And today we have inflation. Inflation is running an unknown number depending on the scale that you're looking at, because there's multiple ways to measure inflation, running at something between maybe about 6 and 9% per year. Now, I will point out, at any of those inflation rates, 6%, 9%, if you have a mortgage at less than 6%, at the sort of 5.3% that we saw on average during the course of the month of August, you're literally getting free money. You're paying back that loan with dollars that are inflating, going down in value, if you will, at a rate more quickly than the interest on that loan is being charged. They're literally free loans to you. You're not having to pay in real dollars, meaning inflation adjusted dollars, the same level on that loan every month. Your real dollar payment's actually going down. Your nominal dollar payment, the dollars you see, that stays level during the course of your fixed rate 30-year loan. But your actual real dollars are decreasing in terms of your monthly payment. It's literally free money. Now, let's talk a little bit about what the Fed is doing, why it's doing it, and why I think it's wrong. And let me preface this comment with, why is Justin qualified to make these comments? Well, the members of the Federal Reserve, the voting members and the non-voting members of the Federal Reserve, they have PhDs in economics. I don't have a PhD in economics, but I do have a PhD in business, and I've studied at a PhD level economics as well as sociology and statistics. So my educational level is actually the same as members of the Federal Reserve, although it's specifically in a slightly different but allied field. Now, there is a joke, and there's some truth to the joke. If you ask 3 economists for their opinion about something, you'll get 5 opinions. So in reality, if I have the economic training and education to understand what's going on in the marketplace, I have every bit as much capability as speaking accurately about what's going on as members of the Federal Reserve. One of the challenges in the Fed right now is that all of the members tend to have exactly the same type of economic training. And that means when they speak, they're speaking with a particular set of knowledge that's not being challenged by other members around them. And this leads to a process referred to as groupthink in the psychology and social psychology literature. Groupthink is where information starts to become constrained and people start to agree, decision makers start to agree with each other because they're not getting outside information. because they don't have the tools to analyze the outside information that they're not getting anyhow. And it tends to lead them to make decisions that are linear when nonlinear decisions are probably called for. In the current situation, we do have elevated inflation, and the Fed has a dual mandate to restrain inflation, but also to maintain high levels of employment. In fact, maintain employment at near full employment levels, which means something in the approximately 4.5% range on employment. Now, employment right now, nationally, is running at about 3.7% over this past month. So we're beyond full employment. The labor market is definitely really tight. Now, part of that is because of lower levels of labor force participation. So there are some people who've pulled themselves out of the labor market who could come back in, and that would actually statistically increase the unemployment rate. The question is, how do we get those people back into the labor market? Or we could do things that kill off job creation, and that would, of course, increase unemployment. The challenge with that, of course, is if you kill off job creation, you cause some people to become unemployed, and they no longer can participate fully in the market. They can't consume in the same way as if they were employed. They therefore restrain economic activity. They pull down demand. Well, that's why the Fed is increasing interest rates. They want to pull down demand. They actually want to increase the unemployment level, and they're finding that to be hard to do. Now, there's a couple problems with this. The Federal Reserve, in their strong desire to curtail inflation, is focused on inflation that actually cannot be well curtailed by increasing interest rates, right? There is demand side inflation, where if you reduce demand, you literally are reducing the problem that's leading to inflation. Too many people trying to buy too much stuff, and they're bidding against each other to bid the prices of that stuff up. There's supply side inflation, where there's just simply not enough stuff in the economy. And so people who want that stuff are having to go out and fight for that stuff against each other, and that's pushing prices higher. But it's not because there's too much demand, it's because there's not enough supply. What we have in this economy right now is a supply-driven inflation problem. Now, I say that for a couple of reasons, and the proof of this is in these couple of reasons. One, we have problems with the movement of goods internationally in a very global supply chain. Now, these problems are manifest not because it's a global supply chain, but because we have not fully recovered from pandemic-induced shutdowns, where we have ships and containers spread all around the world in the wrong place, and we have manufacturers that have not opened or have opened and have reclosed. And all I have to do is point to China, the largest or second largest exporter in the world, and we see multiple major manufacturing cities in China today, as I record this on September 7th, are locked down. Their manufacturers are closed. They're not producing anything that would otherwise be sent for export. We have chip shortages, still computer chip shortages that are not potato chips, that are causing problems in the building of cars, in the building of cell phones, in the building of computers, because those products need to have computer chips embedded within them. And so we don't have enough cars ready for actual sale because they're waiting for the computer chips for their infotainment systems, or for their emergency braking systems, or for their ignition control or pollution control systems, or etc. So that means there's too few cars sitting on auto dealer lots waiting to be sold. We have this problem actually throughout the economy. It's not just computer chips and therefore cars, cell phones, computers, robot vacuum cleaners, etc. It's everywhere, right? And what's the proof of that? Well, one of the things that we see is that as interest rates go up, it makes it harder for companies to invest in building the things that alleviate supply problems. New factories, new port equipment to speed the processing of materials through shipping ports or through airports, new solar panels, right, etc., new batteries for electric vehicles. These things are all being restrained because we don't have the ability to inexpensively build the production facilities for these types of items, because interest rates have gone up, which makes building more expensive, and therefore it's harder to build those factories. Well, what's a really good example of that? Housing. As interest rates have gone up, it's become harder for builders to build houses. Why? Because their cost of engaging in the building activity has gone up. Like all companies in the US, builders rely on leverage, meaning they borrow money and then they pay back that money upon the sale of a home. Well, if they're borrowing money at 2.5%, that's nice. If they're borrowing money at 5.5%, that's a lot more expensive for that builder to carry the house while it's going through the production process. And so it costs them more to build that house. As well, other supply problems have been impacting builders. Lumber, which has come down in price dramatically recently, has been very elevated in price and in short supply. Concrete, right now it's very difficult to get HVAC equipment, heating, ventilation, air conditioning equipment to building sites. For a little while, you could not find anywhere in the Las Vegas Valley baseboards. So builders are having to pay more money for labor. They're having to pay more money for materials. They're having to build at a slower rate because the materials are in short supply. And during that time, they're holding money that money itself, which is paying for all that building, is more expensive. And some of the people who've written contracts with builders to buy a house are dropping out of those contracts because now they don't qualify for the purchase because they were very marginal on the interest rate, or because they're scared and think, oh, prices are going to be going down. And so that builder now has a house that they had thought they had pre-sold, comes back into the market. They need to go look for a new buyer while they're carrying that property at higher interest rate. Now, am I making this up? No, I'm not. Actually, builder sales have been down all year long, right? They were writing lots of contracts last year. Net sales, which is current sales minus contracts that have been canceled, net sales have been coming down all year long. Now, actually, August, we started seeing net sales increase every week, but just marginally. So we see builders under significant stress. Well, what's that doing? It's actually reducing the supply of new build houses coming into the market. Houses are undersupplied for a variety of reasons in the residential real estate market all across the country. It's definitely true here in Las Vegas. It's true everywhere across the country. Since 2008, houses have been underbuilt. New construction houses have been underbuilt at some number, depending on which source of data you're looking at, between 1.8 and 4.8 million units. Now, because Las Vegas has a relatively high level of building activity, because we're a growing environment, that means that underbuilding has been more extensive here than it has been in places like Detroit where there's not a lot of underbuilding because there was not a lot of building in that environment to begin with. So how many houses are we down here from what we should be to supply the population? I don't have a good number for that, partly because these are estimates by looking at what was actually built relative to trend, sort of pre-2004 trend, to take out the bubble building that had taken place in that 2004 to 2007 timeframe. But looking at that trend, it means that we've got knowledge of the number of houses based on population and that trend that should have been built here in Las Vegas. We're down by tens of thousands of units from what we should be. And if builder activity is slowing, that means we're not closing that gap. It means that we don't have the new production of homes that we need to be able to solve the longer term issue of lack of supply in housing. Well, what does that mean? One, it means housing prices will go up. I can't tell you exactly what that number is going to be. It's speculative into the future, but housing prices will go up. There will be housing price appreciation in every environment that is a growing environment, and Las Vegas fits that bill. Las Vegas gets more people moving here every year, more jobs opening here every year than most every other place in the country, and therefore housing prices will go up, especially if we're inventory constrained. And when we don't get new supply into market, meaning new construction supply, we're inventory constrained and prices will go up. Now, there's another important factor here. Housing price appreciation, the price of houses going up, that's appreciation on an asset class. That's not inflation. It's literally excluded from measures of inflation. But housing is included in inflation. And what that means is rent and owner's rent equivalent. Rent, let's just talk about it that way because that's a majority of the way in which the data is calculated, is rents go up. That literally is an inflationary force. And the three biggest factors in the inflation rate in terms of the statistical calculation of inflation: fuel, meaning gasoline primarily, food, and housing, specifically, again, rent. Rents have been going up. Why? Well, there's a housing shortage. And while we see a lot of new apartment buildings being built, which is great, we see actually there's a shortage of rental housing in the Las Vegas Valley, and that's pushing rent prices higher. So what the Federal Reserve is doing is they're increasing the cost of building by increasing the interest rates. They're increasing the cost of building and reducing the amount of building that's actually taking place, which is causing inflation as rent rates. So in other words, what the Fed is doing is not only not directed at solving the supply problems, which are creating inflation, but they're actually exacerbating the supply problems with regard to housing, which itself is part of inflation. So the Fed has found itself on this mission where they're not looking at some of the really important spillover effects of what they're doing by simply being focused on headline numbers on inflation. This is really problematic. Now, the Fed historically has decided that at certain times they need to go out and combat inflation. And the tool they have to do that is the Fed funds rate, and they increase the Fed funds rate. And they've done that 9 times over the past approximately 100 years. And 100% of those times, they've induced a recession, right? They've increased interest rates too far. And once they realize, unemployment's going up, it's problematically going up, And inflation is coming down because we're killing off demand because no one who wanted to buy things has the capacity to buy things any longer because they're unemployed. And so then they start to lower interest rates, but not without creating a recession, which is damaging to the economy and damaging to those people, those families that experience unemployment. Now, kind of an interesting thing, I will note, during recessions, housing prices tend to go up. Part of the reason for that may be because housing inventory starts to become more constrained because new builds start to become suppressed in the environment because of higher interest rates. And therefore, part of the reason that housing prices go up when we're in recession is because the Fed is inducing activity in the new construction market, which is actually causing greater supply problems, which is causing prices in residential real estate to increase. So it's a little bit counterintuitive, perhaps, but that's actually what takes place in most recessions, and undoubtedly will take place in this recession because we've seen net sales numbers for new construction come down pretty considerably. Now, with that background, let's dive into the numbers for single-family resale in the Las Vegas Valley for the month of August. So remember, this is the September market update. We always look at the data from the prior month. And so it's September 7th as I record this. So the data has become fairly stable in the data set, the multiple listing service. And so we can start to look at that. Remember as well, I parcel out new construction that has somehow found its way into the multiple listing service. Because new construction that gets into the multiple listing service is motivated there in a way which is different than that for resale. So the numbers that I put out have been cleaned of a separate population of data, new construction that found its way into the MLS, and I'm looking only at resale. That means that the numbers are a bit different than what you're going to hear if you read the press releases coming from the Las Vegas realtors, or you read the newspapers that simply parrot those press releases, or you listen to YouTube channels that again simply parrot those press releases because people don't actually understand how to engage in a proper statistical analysis. So, resale price for single family resale residential real estate in the Las Vegas Valley in August of 2022, $445,000. And again, I'll just point out, a lot of other sources are saying it's $450,000. It's because they're not taking out that new construction property that had been listed in the MLS that happened to close during the month of August. It's not real, it's not resale. So we've taken it out, $445,000. Now that's down. It's down from $465,000 the prior month, down $20,000. That is down 4.3%. The market crashes, 4.3%. Last year we were up approximately 24%. We're down 4.3%. That's not a very substantial decrease. Now, this is actually the third decrease, however, in prices. They had peaked at $480 in May. We are down 7.3% from that peak for single-family resale residential in the Las Vegas Valley. 7.3% from that peak of $480,000 achieved in May. And I'll talk about that a little bit more in just a minute, but let me get a little bit more data on the table. Year over year, so from August 2021, we were at 403,000, and we are up 10.4% over the course of the past 12 months. So we're down 4.3%. Month over month, we are up 10.4% year over year. And we ended 2021 at 425. We're up $20,000. We are up 4.7% year to date. So if you bought a house on January 1st of 2022, you're actually sitting on a gain. Even though prices have been coming down for 3 months, you're still sitting on a gain. Now, if you bought a house in January of 2022, I don't recommend, unless you absolutely need to, selling it right now, because your gain is going to cover most of your costs of getting back out of that house and nothing else. You're going to end up pretty close to flat, right? But it means that even though the market's crashing and prices are collapsing and everybody's running scared, you're actually up 4.7% year to date over the past 8 months, right? January 1st through August 31st. Not bad in a crashing market. 8-month return, 4.7%. It's a heck of a lot better than you're getting in your savings account. It's dramatically better than you're getting on your Bitcoin trades. It's a lot better than you have in your stock portfolio, unless you're an active investor who is really paying very careful attention and making very specific, correct moves in the stock market. Hard to do over long periods of time. So that's the crash that we're seeing right now. Down 4.3% month over month, up 4.7% from the beginning of the year. Really hard to call that a crash. There are people who are putting out there, spewing information and quoting each other and parroting each other about how horrible the market is. It's going down 50%. It's gone down. It started in January, et cetera, et cetera. I understand that it's confusing and disturbing. It hits me, and quite frankly, I'm confused by where they're coming up with these crazy ideas, and I find it disturbing because it's scaring people. It's scaring people into making bad decisions. So this is actually what the correct information is. Now, one other way to look at pricing, price per foot. $254 per foot, the median sale price in the month of August 2022 for single-family residential. That is down. It's down 2.7% from $261 per foot in July. It's up 14.9% from $221 per foot in August of last year. Now, do note we're down a little bit less on price per foot than we were on median sale price month over month, and we're up a little bit more strongly year over year on price per foot. And that suggests something about the distribution of properties that are being transacted. And right now, as interest rates have been going up, we might expect those who are more dependent on getting a loan are probably pulling out of the market a little bit more quickly, either because of need or because of fear, than those who can pay cash or those who know they can refinance a few months into the future as interest rates come down, and therefore are less concerned about or have access to better information, and therefore are less scared about what's going on in the market. And so we're seeing a little bit of shift. It's not real pronounced yet, but a little bit of a shift toward the higher end of the market. So clearly the median is still the middle, but as you eliminate some of the transactions below that median price and put them above the median price, that shifts the median up a little bit. And it's shifting price per foot higher a little bit more. Now, let me just point out price per foot, and I've said this multiple times, is a very imprecise way to think about real estate and the value of any particular property, because we don't transact on price per foot here in the Las Vegas Valley. In some markets, it's a really good indicator where everything is pretty much identical, including the neighborhoods across which properties exist. In Las Vegas, it's not true. And remember, what loads into price per foot, the denominator of that is the number of square feet in a house, but the sale price is the numerator. And what goes into the numerator of that, it's whether or not there's a pool. It's the size of the property. It's the quality of the finishes. It's the type of appliances, right? And so as we see properties that maybe have larger lot sizes and that have maybe higher end appliances, that have more windows, because windows are a more expensive building proposition than non-windows. We start to see price per foot go higher. So higher end properties, it's not just simply that they cost more because they're higher end. Rather, it's because there's a lot of things that load into that sale price, and there's fewer square feet across which to divide that sale price. So a 2,000 square foot home that sits on an acre is going to be valued much differently than a 2,000 square foot home that sits on 1/10 of an acre in a dense neighborhood, right? But it's not because that house is necessarily any different. It's because there's a lot of land that goes with that property that sits on the 1 acre lot. So as people move toward larger lot sizes, perhaps in preference, that's going to skew also price per foot higher, for example. So there's reasons for that to vary, but it does give us some insight into what may be happening in the internals of the market instead of just talking about here's the center point. Now, there's one other thing I want to mention about the price at $445,000. And that is, I want to make a comparison back to June of 2006 when we had peaked just before the financial crisis set in. At that time, prices were on an inflation-adjusted basis, $448,800. And the average interest rate at that time was 6.75%. So if somebody took out a 90% loan to value 30-year fixed rate loan at that average interest rate on that median house, the monthly payment was $2,595 per month. So let's do the same calculation on the August number, $445,000. So just about exactly on an inflation-adjusted basis, that median home in June of 2006, 448, we're at 445. And at the average interest rate, 5.3% during the month of August, and we take out 90% loan to value, 30-year fixed rate loan, that median transaction in Las Vegas last month, assuming that the median house was financed at the average interest rate on a 90% loan, $2,209 per month. We are down $386 per month on the cost of owning the average home under the average terms in Las Vegas from where we were in June of 2006, right? Just slightly more than 16 years ago. We're down $386. Now, people talk about affordability all of the time, and there's reasons, I guess, to talk about affordability. It's interesting in some kind of esoteric manner. Yes, it is true that if somebody cannot afford to buy a home, they cannot afford to buy a home. It is true that as interest rates go higher, it becomes harder for some people who were marginal in the market, not meaning bad, but meaning they were at sort of the cap of what they could afford. Interest rates could push them out of the market and actually make them renters because they can't afford to buy, meaning there's more people who are renting, which pushes up rental property prices even more, which is inflation inducing, contrary to what the Fed would like to be doing by increasing interest rates. But there's all sorts of solutions to affordability. There's all sorts of ways to make a property more affordable. And I don't mean by lowballing an offer. I don't mean by going and finding a wealthy uncle who will pay cash for you. Affordability is this ephemeral concept. It's illusory. There are ways to get around affordability issues, and frankly, if you're having an issue with affordability, talk to me because we can solve that problem. I have tools in my pocket that I can use to solve that problem. And I'll just say, the average real estate agent is a salesperson who has training as a salesperson. And the average real estate agent's been doing real estate for whatever period of time. A lot of them for less than a year, some of them for very long periods of time. They have experience using the tools in their toolkit. Because my background is not sales, it's easy to pick up those tools. But I've got a lot of other tools in my toolbox that can help you do things that other real estate agents would have a really hard time doing. And so, for example, in August, we got a record sale price on one of our listings in a neighborhood. Even though prices had come down in August by 4.3% from July and are down 7.3% from the peak in May, we got a record sale price in a particular neighborhood. Because I have different tools in my toolbox that I can use to help buyers or help sellers to achieve differentially in this marketplace. And by the way, I'll just say this as well with regard to other real estate agents. And I don't mean to slam other real estate agents. There are some out there who are equally spectacular in terms of what they can do to what I can do. But there's a lot of real estate agents out there who do only at the average, actually. The average real estate agent last year, with the greatest number of transactions in the history of transactions in real estate in the Las Vegas Valley, the average real estate agent did fewer than 4 transactions last year. And so they're not gaining the experience in the market as the market's existing at any particular time. And so they're not acquiring new tools. And where they go to get their information then is not necessarily the great places to get information. And so there's a lot of real estate agents out there who either are not paying any attention to what's taking place in the real estate market, or they're really scared about what's taking place in the real estate market. And so we see this in list prices, for example. There are a lot of properties that come into the market that are priced as though we're in 2021. They're just priced really high. And those properties either get multiple price reductions and or they drop out of the market. They're not selling at ridiculously high prices. It's not happening. They didn't really happen last year, but you had a little bit more leeway to price super high. And I'll just comment, we've gotten record high pricing on sales in multiple neighborhoods last year and this year, and on a number of different condos last year and this year, and not because the market's necessarily going up and not because we're overpricing. So overpricing is problematic. There are agents out there who are super scared, and it's leading to some properties being priced way low, destroying value, frankly, for a neighborhood, but also for their clients. They're leaving all kinds of money on the table. And by the way, pricing low does not necessarily guarantee a quick sale. We've seen low priced properties languish on the market for long periods of time because they're not understandable in the marketplace. They're priced wrong. You need to be priced right. You need a real estate agent who can give you the advice about what pricing should be. You need to listen to that and take that into account when you're setting the pricing on your property or when you're thinking about buying a property. It's really important that you work with a real estate agent who understands what's going on in the marketplace. All right, now let's move on to the number of units sold. In August of 2022, single-family residential resale, 1,856 sold properties in Las Vegas. That's down. It's down 6.3% from the 1,980 that had sold in July of 2022. Now, that being down is not inconsequential, although the rate of decline has actually slowed because we were looking at double-digit declines in June and July. So the number of transactions has slowed. I had commented in last month's market update video that in the first part of August, it looked as though sales might actually exceed July. I can say that again. It looks like September sales will exceed August. I did note to you that one of my regular informants, a title company vice president, had told me that it informed me that actually the start of school had moved this year relative to where it normally is in the calendar, and that might pull down sales in August relative to what I might otherwise expect, especially as we got into the back half, the second half of August. And so it seems to be what's happened. And so we're down a little bit on sales, but we're not down a huge amount. We're down 124 houses relative to where we were in July. Now, we're down a lot from where we were last year. We're down 41.5% from 3,172. Remember though, last year, record sales volume. So the year-over-year comparison is kind of meaningless. When we get to comparing August of 2023 with August of 2022, we're going to see a significant year-over-year gain because the numbers this year are showing up a little bit weak. All right. Now, let me ask this. Please, if you find this interesting or useful, smash the like button, subscribe, and your reward, here's a picture of a teddy bear sitting in a tree. Okay, now that we've accomplished that, and I appreciate you smashing the like button, it helps to make sure more people get to see these videos. Let's go on to that data, which actually looks forward in time. So it's data from the past, data from the month of August, but it looks forward. And it gives us some bit of insight into what's going to happen next month, meaning the current month, September. Pending home sales. That's contracts written for the sale of a resale property, 2,134. That number is actually up. It's up substantially. It's up 22.6% from the 1,741 pending home sales that we saw in July. That's right. Pending home sales month over month up 22.6%. Now that's one of the reasons why I have confidence that the September numbers are going to look stronger than August. Pending home sales are up. They're up strongly. They're up 22.6% relative to where they were in July. Now, that's interesting. Now, I will note, of course, last year is super strong, and we're down 39.6% from the pending 3,553 that we saw in August of last year. Right? Again, year-over-year comparisons, I put them in here just for symmetry with all of the updates that I do, but it's a misleading number, and therefore you should not pay attention to it. It's a comparison to the absolute peak number year that we had seen in volume for sales, for pendings, and record lows for inventory. So making comparisons off those high and low data points is actually statistically problematic. And so looking at that number, not helpful. Again, I included just for symmetry across all of the market updates. Now, by the way, that pending number relative to the prior month, first time we've seen an increase over the past several months. Right, so that number says, hey, we've probably hit the bottom on sales for this period, and we're going to see stronger sales going forward. Now, I will caution you right now, just because some people, when we get there, will point out, oh, problem, crashing again. November and December are seasonally the weakest volume numbers of the year, right? It's a seasonal pattern that we see every single year. And so when we get to the numbers for November and December, we'll see numbers come down. That's seasonal. It has nothing to do with shift in the market, change in the dynamics of the market, people getting scared and fleeing, or collapsing or crashing or anything like that. Right? So September will be stronger. October, in all likelihood, will also be a good month, probably stronger than September. November, December will be weaker in terms of volume. Okay, what about for sale? Standing inventory that can be sold. 8,199 houses, single-family residential resale in the Las Vegas Valley for sale in the month of August. Now that number is up, but it's up just very marginally from where we ended July, when the number was 8,053. So we're up 146 houses in inventory from where we were at the end of July through the end of August. That's almost equal to the decrease in the number of houses that were sold. So that's rather interesting. The inventory build that took place last month is coming from sales that did not actually occur. And I can show that also with new listings. New listings into the market, new resale listings, existing homes with existing owners coming into the market to be sold in August, 3,992. That number is down. It's down 10.8% from the 4,475 that had been listed in the market in July. It's actually down year over year as well. It's down 4.4% from the 4,165 that we saw listed into the market in August. Now, this number is a little below normal. And so that's actually, I think this is good. New listings have come down each of the past 2 months now, which I think is probably indicative of a lot of sellers listening to real estate agents telling them, you better get out now, things are collapsing, and maybe thinking through what they're being told. Oh, the market's not collapsing, I don't need to get out now. Now, it could also be some sellers are hesitant about changing their house because they're in a really low interest rate mortgage right now and they don't want to go to a higher interest rate mortgage. Looking forward in time, that's a potential problem, because those people who feel they're stuck in their house with a really low interest rate and therefore cannot move, their houses won't come into the market for resale. And of course, we need inventory in order to have buyers be able to buy things. Houses that were bought by large investment firms, Innovation Homes, Home for America, etc. Those houses, they're in the rental pool. They're not coming back into the housing market. Right? So we have a lot of houses that exist out there that will not come into inventory for sale anytime in the proximate future. And we don't have a lot of new construction taking place because new construction is down. And home builder sentiment, by the way, has plummeted every single month this year, including in the month of August, even though net contracts for builders have increased a little bit for each of the weeks of August. So we have a budding inventory problem here. Now, I say that knowing that we have a lot more inventory than we had last year at this time. We've got 64% more inventory in the single-family home market than we had last year. But we're going to start to see inventory numbers coming down. Now, that may not happen in September. It may not happen in October. It's unlikely to happen in November or December. But once we get to 2023, we're going to start to see inventory problems rematerialize, and we're going to see the problems of housing shortage rematerialize in the resale market here in Las Vegas. All right. So one other statistic that I've been giving for the past year plus. Back on market. Back on market in August of 2022 for single family, 927 units. That's exactly 1/3 of the contracts that are written. 33.3% of contracts are written. It's basically flat from July's number. It's been trending down a little bit over the past few months, and I expect this to continue to trend down. Not sharply, but a little bit, because I expect to see better results on inspections and requests for repair, and I expect to see probably a little bit better quality on appraisals just because the market is approximately flat. If the appraisers start marking their appraisals down thinking the market's collapsing, that's a problem. But if appraisers leave their valuations as being in a flat market, then we should start to see appraisal problems mitigated as we go forward in time, and that'll push back on market down further. So that's what's going on in the market. Crash? No. Sales down just marginally. Price down 4.3% month over month, 7.3% from the peak, but still up 4.3% from the beginning of the year. We do not have a market crash. We're not going to have a market crash here in Las Vegas. We don't actually even have anything other than what might be called a market correction. In the stock market, which we can use by analogy, bear markets start when a market is down 20%. That's definitional. Stock market goes down 20%, you've entered into a bear market. Stock market goes up some amount, you get a bull market, a trend line that's going up. And so you go down 5%, you go down 10%, you go down 12%, you go down something less than 20%, you're still in a bull market. You're still in an uptrend. And that's what we have here in Las Vegas. Housing prices are trending higher, even though we've seen a little bit of consolidation in a correction over this past couple months. Why do markets consolidate? Because people like to rotate their investments. They like to take money, some of their gain, out of some particular investment and move it into some other particular investment. That's healthy for the market. Otherwise, if you were riding on all of your gains and the market really turned, everybody rushes to get out all at once, you get a collapse in the market. We don't have anything like that taking place. People have been rotating in and out of their properties. There are significant gains that a lot of people are holding on to. In fact, equity positions in the US housing market are incredibly strong right now, stronger than they've ever been in history. But people are not in a situation where they have problematic debt and need to get out, and some people are starting to rotate. Myself, we're actually rotating some of our investments right now, and we are literally redeploying capital into the housing market right now because we see some sellers and some of their agents are panicking, and there are some great deals out there right now in a market where there's a little bit more inventory to look at. This is actually a really good thing. It's a healthy thing in a market. Markets that only go in one direction, problematic health problems materialize in those markets. And so this is good to have this correction right now. So I am Justin Miller with the Chong Miller Group. We help people buy and sell homes. Please subscribe to our videos. Please, if you know anyone who might benefit from this information or who's thinking about buying or selling a home, reach out to them, send them this video, share it with them, or send me their information. I'd be glad to sit down and talk with them and see how we can help them, and I can utilize all of the tools in my toolbox to make sure that they're coming out better than they can with almost anybody else that's out there. Thank you very much. I look forward to seeing you soon.